Hello, hope everyone is having a good semester. We're going to look at chapter 6 today of, again, our textbook here, internal auditing. We're going to look at internal control. Of course, this entire book is about internal audit, but internal control about having proper control set up. A lot of first few pages here, chapter 6, a lot of just reading there about the various frameworks. Obviously, COSO, Committee of Sponsoring Organizations from the Treadway Commission, is a big one here for the framework. Governance frameworks, enterprise resource management, or excuse me, enterprise risk management. And they go into some detail here on page 65, talking about the Sarbanes-Oxley Act of 2002. You'll encounter that regardless of what type of job you're going to end up in, whether you're an auditor or you're being audited, whether you're in the corporate office or you're at the plant level operationally. Very important, the controls that came out after the Enron debacle in early 2000s. We'll jump over to some of the more specifics in this chapter. 6-9, the COSO cube there, the 5 areas: control environment, risk assessment, control activities, information, communication, and monitoring activities. That's pretty much the cube. And you can see at the top there, the operations, reporting, compliance, and how those are dovetailed together. So when we get over here to 6-11, we're getting into the meat of this. And we've looked at ETSU and K-State's websites. I would encourage you to look at that as well to see how they pretty much have taken this information, theoretical, and put it into their websites for their internal audit department, and to inform the users that want to see what types of internal control are being used. But the first is obviously the control environment, the tone at the top. A lot of times these are broad statements of what the board of directors wants to do, what type of committees have been set forth. Usually finance committee is one of the ones that is always going to be there in most companies. The risk assessment, control activities. Again, you can read that. You don't need me to parrot back what is mentioned here. Information communication on 6-14. And that's communicating in a lot of ways: hard copy, forms of communication. Sometimes you use bulletin boards to announce various things. Maybe it's wage and hour laws from Department of Labor. Areas where individuals congregate. Maybe it's 1-800 numbers. I know which came out again after Sarbanes-Oxley. Then monitoring activities, which really occurs in each of those 5 components of internal control, and not just something that's separate. Jumping on over to page 6-19, that's an excellent page there on the 17 principles for achieving effective internal control. All 17 principles there: the control environment, the risk assessment, control activities, information communication, monitoring. This is more detail here than what you'll see on K-State or ETSU's website for internal audit. The board of directors, internal auditors, other personnel. To get into the limitations of internal control on 6-21, limitations are important because there's no system that is perfect. The suitability of the objectives that are established as a precondition to internal control. What about human judgment in each of these items? And decision making can be faulty, maybe some bias there. There can be something as simple as errors that occur. Human failure, maybe software failure. What's the ability of management to override these internal controls, right? That's always a limitation. Or the ability for management, third parties, to circumvent controls, maybe through collusion. And external events that may occur beyond the organization's control. I want to jump on over now to 6-25, because the last part of this is really what I want to talk about the most from this chapter. The types of controls here: entity level, process level, and transaction level. PCAOB on top of page 626 talks about the entity level controls, but even more specific there on process and transaction level. That's really where the rubber meets the road, on making sure your company has a solid foundation for control. And they start with process level controls. And these are reconciliations of key accounts. I know oftentimes external audit and internal audit as well will want supporting documentation for your asset balances from your trial balance, because they're always concerned about assets being overstated, right? They look at that more so than they look at the liabilities. Not that liabilities aren't important, but the assets, because that's one whole side of your balance sheet, right? Assets equals liabilities plus equity. So reconciliation of key accounts, physical verification of assets. Inventory is going to be, if you're a merchandising or a manufacturing type, warehousing, you're going to have at least one physical inventory a year to verify your perpetual inventory, if you've got a perpetual system, and most companies do. The verification of assets and inventories is a snapshot, because there's a lot of things going on with your inventory flow that 1 year tells you what's happened the entire prior 12 months. But it's not just inventories, property, plant, and equipment. I mean, I'm accustomed to, at the plant level, where most of your operating assets are, fixed assets are, that they would have a rolling physical inventory that over a 5-year period, all of your assets would be inventory. So you're not inventory all $30 million worth of book value assets in a year. You're going to inventory if you've got $30 million of inventory and $30 million of fixed assets. $30 million of inventory is just a drop in the bucket. If you're turning inventory over 12 times a year, right, that in essence is what? That's 30 million times 12, $360 million that's flowed through, and you're catching one time, making sure it's accurate. But your fixed assets is this $30 million that's been invested over the years that is driving revenue. And so from a control standpoint, inventorying a fifth of the assets every year. We used to, at Exxon, we would have, if it's over $100,000 book value, those would be inventoried 1 year. The next year, those between 75,000 and 100,000. The next year, 50 to 75, and so forth. And the big one, or the last one, would be the ones that were below 25,000. But they would try to break that up into a 5-year plan and divide your assets somewhat equally into 5 buckets that would be inventory. But it is important to do that. But again, that's just the physical verification of your assets for fixed assets is not nearly important as the inventory. In fact, you don't hear much about fixed asset inventory, but they do exist. It sort of falls under that safeguarding of assets, physical security of those that equipment. But this is getting down to the process level, which I like, so you can kind of understand what you're up against. Processing, employee supervision, and performance evaluations. Do you have competent people who are getting decent reviews, right? Process level risk assessment. What is the risk? What's the risk of the assets the fixed assets being verified over a 5-year period? Is that sufficient for your risk assessment? I mean, do you have the time to do 100% of the fixed assets every year? At Exxon, it wasn't that important. Of course, there would usually be some surprises, because you have potentially a $20,000 asset that you couldn't find on your production floor. You think, well, what happened to it? Especially if it's something large, it just didn't get carried out of there in somebody's lunch pail. Well, oftentimes stuff like that can be cannibalized. Maybe stop working and use parts from that on other parts of the equipment. If your maintenance and repair expenses were high, or they were low, and people wonder why your expenses are low. Well, if you're using other equipment to fix up, using some fixed assets to fix up, to repair other fixed assets, that's a potential. So you're always concerned about things like that taking place. Monitoring oversight of specific transactions, going through the transaction register for maintenance and repair expense every month. Are there things in there that are being capitalized or being expensed that should be capitalized, or vice versa? Maybe some things are being capitalized that should have been expensed. And then the transaction level, bottom page 626, authorizations, having authorization for purchase requisitions that become purchase orders that you receive against and then you pay against. Write the check. Somebody does the bank reconciliation. Who's authorizing that? Documentation, source documents. Segregation of duties. The three-way match I talk about in 30-20. If you took 30-20 intermediate here. But the three-way match I just went through: purchase order, receipt, and then paying the invoice. Those three have to go together in order to pay for whatever it is you purchased. IT application controls, input, processing, output, which we'll look at, I think, in the next chapter. And so now those are the types of controls: entity level, process level, and transaction level. But then on 627, we start breaking that out into or categorizing based on their level of importance. So you got key controls and you got secondary controls. Secondaries to support key controls if they fail. Compensating controls gets a lot of talk. And when you're talking about compensating controls, it's really to supplement when maybe your key or secondary controls fail. You think, well, what might that be? Well, I can tell you, having worked in payroll and accounts payable, especially payroll, using software systems. The first software system we bought back in, it's been 35 years ago, paid $100,000 for an HR system that had payroll attached to it and time and attendance and all kinds of things. But out of that system, because again, you had a segregation there of what HR would do in controlling job pay, history, and so forth. Payroll would process the time, and then you had production or departmentals that would report the time. But that was like a segregation of functions there among three. But even then, if anyone ever made a change to the HR database, there was an audit report would come out on a daily basis. And that's an exception report, which is a compensating control. This exception report or audit trail would come to me as being someone that wasn't making transactions in this payroll personnel system or this HR system. It would come to me to review and sign, and we would file that away. And most software systems are like that today. They may not print it out, they may look at it online and retain it that way potentially, but we always kept hard copies of that because it showed us anybody who made any transactions. But that's a good example of a compensating balance. Maybe a secondary signature. We talk about the three-way match in accounts payable again, and purchasing, the procurement process. Maybe a department manager can approve a purchase order or purchase requisition up to $1,000. And when purchasing or procurement gets that from the user, then they will process that. What if it's over 1,000 or 5,000 or 10,000? Usually if it's over 1,000, then it bumps up to the director level, from the manager level for 1,000, director level, maybe 5,000, maybe vice president if it's a $10,000 or more purchase order. So those are secondary signatures, are also a compensating control. Another one, give you a third example, would be if you've got a clerk that is recording cash receipts and he or she is recording that as a journal entry into the ledger, into your bank account, as well as making the deposit. Maybe you're so small you can't segregate that function out. And so the manager will look at maybe not all of them, but most of them, and do a visual on, are the totals accurate and has it been recorded accurately? Of course, then the issue there is, what if they're pocketing the money before they ever make the deposit, right? Especially if it's cash. And I say cash, not talking about checks. But more on that here in just a second. But then the second part, or the next part of this, is preventive and detective controls, bottom page 627. A preventive control is designed to deter unintended events, right? Prevention. Ounce of prevention is worth a pound of cure. Every time I bring that up in 30-20, nobody knows what I'm talking about. An ounce of prevention is worth a pound, which is 16 ounces of cure. Use that a lot of times in talking about catching quality issues early in the process before it gets out at the end when it gets very expensive. But having preventive controls, maybe locked doors, keeping your check stock under lock and key, or your signature plates if you still use something like that. Maybe user IDs and passwords for certain functions. And most software provides for that. And then a detective control is designed to discover undesirable events. Security cameras used a lot today to watch front desk or where cash is being received. If somebody's a walk-in, right? Maybe that's detective is used to control the compensating control, right? Computer logs for unauthorized access attempts. How many times do you get to see that? Well, you get 3 tries and then you're locked out and you have to call in. Well, I guarantee you that's all going to a log that someone's looking at if you fail once. And when it's 3 times, that's when there's obviously got to be some site oversight into what's taking place. The next part, information systems controls on 628. I believe our next chapter talks about the general computing controls and application controls, so we won't worry about that. All right, so that's chapter 6. Something that I think I skipped over, I meant to talk a little bit about back on page 619. That's a great document there, right? 17 principles. Now, I put a example out there. I'm not sure how I'm going to use that, maybe later on in the semester. But I want to share a link I've got out there for Bristol, Virginia Utilities Board. A lot of stuff that went on there probably 5, 6, 7 years ago. A lot of fraud. A lot of people went to jail for it. And personal liability for things that is involving federal money, the IRS, and so forth. You really get in a lot of trouble personally, not just get your company in a lot of trouble. There's a lot of people who serve time there, and you can read this at your leisure. Let me see if I can share that link there. Let's see. That's not it. Let's see here under content. Let me stop share because I'm not sure you can see that. There we go. You should be able to see this link now. And again, this is in your D2L content. But this was written back May 6, 2016 in the Roanoke Times, Bristol, Virginia. Culture of corruption, entitlement, and greed. As you read this, and it's important that you read this, get rid of some of these ads that are on here. It's amazing what all went on here with this particular utility company in Bristol, Virginia. Extortion, tax evasion, fraud, kickbacks, bid rigging, requiring or demanding, as they say, demanding major vendors to underwrite fancy holiday parties, one costing $12,000, providing executives with choice tickets to football, basketball games, NASCAR races, horse races, weekend trips, riding in limousines, Dallas Cowboys, luxury skybox. And that was all because of what? A $4.5 million contract with the agency. It sounded like they got the lowest quote, did they? Or the best quote. Untaxed bonuses. Now, IRS likes that, don't they? Gift cards, even the gift cards as small as $25, if it amounts up to a considerable amount, was considered fraud. You know, there's a de minimis rule, but they point out it's more than $25. Country club memberships, GMC Yukon, they weren't taxed. All that's got to go on your W-2 statement, right? At the end of the year, if you want to pay the tax that the people are going to get, you got to gross it up. Had to do a lot of that in prior years. Rate increases. Everybody loves that, don't they? Taxpayers. Household income in Bristol, Virginia was $33,600. Poverty rate's 22%. Credit cards gone wild. You know, controlling pro cards. Of course, Roanoke's writing this from a distance, right? One of the guys that left, the guy in charge, he got $270,000 severance, and I think he ended up having to pay back quite a bit of that. Salary was $219,000. Small company, really. Utilities in Bristol, Virginia. Sense of entitlement, obviously, not knowing what the rules are. Dave, but the person's got to know is your controller, your CFO, and she was a little on the corrupt side in what she did. Said she had an MBA degree when she was hired, but did not. They found that out later. Her husband's an attorney. They both served time. Snared and kickback schemes saying, we'll do business with you if you'll give us something under the table. And of course, it wasn't so much under the table. People know they're taking trips to Texas, right? Wasn't much collusion involved there. Look here, this guy, David Copeland, money laundering, conspiring to commit wire fraud. Robert J. Kelly, defrauding the IRS. David Copeland. They approved payment, right? Approved payment of $330,510 for billings he knew were fraudulent from South Carolina-based Edwards Telecommunications. Major contract for BVU's broadband. So as you read through this, yeah, there we get sports tickets, luncheons, dinners, scores table at a private school attended by one of the CEO's children. Rosenbaum was sentenced to 33 months in prison in order to forfeit $150,000 of that, what, 217 or something? And how they arrived at that. Former mayor sold race tickets that he was given for free. CFO convicted. Lawyers contend she was a whistleblower. She was not. You know, that goes back to Sherry Watson at Enron. All right, I have to screen share. Hopefully they kept going, but I lost my picture there. Or maybe I lost everything. All right. All right, going on down through here. A hole in Pomeranke's resume. There's the $270,000 severance there. Wrestler told the board that Rosenbaum's actions violate procurement law, trying to get tickets in exchange for doing business with a contractor. So they decided to give him a severance to resign. I remember when all that came up, people couldn't believe somebody would get that kind of severance pay. This is pictures of people, and I'm not sure what's down here at the end. There's the CFO. There's a good chronology of what took place here, various people, and the dates. But I would encourage you to read this, and it's so relevant because how does this apply to what we're studying in this class, right? Internal audit. I would say you have an internal audit department, small company like that. I don't know how many work there. If I was guessing, I would say 50 to 75 at the most. Now, Bristol, Tennessee Electric on the Tennessee side has about 50. I doubt if Bristol, Virginia is any bigger. But they had some real internal control issues, right? And the tone at the top, that term we saw there in this chapter, tone at the top was corrupt, wasn't it? All the way down. Incredible. And a lot of them will plead ignorance. And think, well, that's just the way you do business, right? If you want something for the good of your company, then you stiff arm, you demand that from your supplier. That goes on all the time. And when you get involved in something like this with federal money, which I think $10,000 is the level, that's when it really gets scary and what can happen to you. But you should never do the wrong thing anyway. But be thinking about when you read that, ask yourself, what would you have done if you were in charge of internal audit there going forward? Imagine what kind of controls are in there now. Just imagine. And the CPA firm that was in there before is no longer being used. It's a local firm. Now they're using another local firm. Imagine the controls that they've got in there now for all of this. But read that article, great article, and it should get the wheels turning up here, and especially what's on page 6-19 here, the 17 principles for achieving effective internal control. Be thinking about what type of controls would you want for this to not happen, right? And some of those we talked about today, from key controls, primary controls, secondary, and compensating controls. I mean, there's no foolproof system, but they had so many holes in their system, mainly because of the override. They may have had internal control procedures and they just didn't follow them. Or they were overridden by people who thought they were entitled, greed. I guess look what they're making there to begin with in such a small company. So that's chapter 6. Hope you have a good day, and we'll talk again soon when we look at chapter 7.